Banks thriving in Trump's economy, what it means for markets and consumers. In the current economic landscape under President Trump's leadership, banks are experiencing unprecedented success. This phenomenon has significant implications for both financial markets and everyday consumers. Imagine walking into a bustling city square where every shop is doing brisk business. This is akin to what's happening in the world of finance. Wall Street is abuzz with activity, driven by a surge in stock and bond trading, along with a wave of corporate mergers and acquisitions. Meanwhile, Main Street remains vibrant as American consumers continue to spend, borrow, and repay loans, according to recent reports from major U.S. banks. This confluence of factors is creating an exceptionally profitable environment for financial institutions. During the second quarter of 2025, the six largest U.S. banks reported a collective profit of approximately $39 billion, surpassing analysts' forecasts by a wide margin. Their earnings increased by more than 20% compared to the same period last year, marking a remarkable turnaround. This success story began with a rocky start. In early April, President Trump's announcement of sweeping Liberation Day tariffs sent shockwaves through the markets, causing stock prices to plummet. J.P. Morgan Chase's economists predicted that these policies could trigger a recession within the year. However, the markets swiftly rebounded once Trump delayed the implementation of the most stringent tariffs and responded to the concerns raised by U.S. bond markets. Investors have grown increasingly skeptical of the administration's frequent tariff threats, viewing them as mere rhetoric rather than concrete actions. As a result, corporate leaders have resumed large-scale transactions, contributing to the bank's robust performance. "Look how far we've come in just 3 months," commented Wells Fargo banking analyst Mike Mayo. "There's been a revival in investment banking, loan growth, and economic optimism." J.P. Morgan Chase, the largest and most profitable U.S. bank, exemplifies this trend. The bank reported a quarterly profit of around $15 billion, nearly equal to the combined profits of the next 3 largest banks. Investment banking, which includes merger advisory services, initial public offerings, IPOs, and debt and equity issuances, saw a significant boost. Revenue at J.P. Morgan increased by 7%, exceeding analysts' expectations by $450 million. "People are embracing uncertainty and moving forward with transactions," explained J.P. Morgan CFO Jeremy Barnum. "Companies are learning to navigate through these challenging times." But the positive news extends beyond corporate confidence. J.P. Morgan's internal indicators of economic risk have decreased since the first quarter, reducing the likelihood of a recession-induced spike in unemployment. This reduction is reflected in the bank's provision for credit losses, which dropped by 14% compared to the previous quarter. The economy is currently on track for a soft landing, according to Barnum. Despite ongoing geopolitical risks and market volatility, the U.S. economy has surpassed expectations for a downturn. Banks are highly sensitive to economic conditions, and their performance is a strong indicator of overall economic health, noted Matt Stuckey, Chief Portfolio Manager for Equities at Northwestern Mutual Wealth Management. Even J.P. Morgan CEO Jamie Dimon, known for his cautionary warnings, expressed a cautiously optimistic outlook. "The economy has shown resilience, and I hope it continues," he stated. A more diversified global economy provides greater stability compared to 2 decades ago. Trump's recent spending bill, which maintains corporate tax rates and expands business deductions, further supports economic growth. Additionally, the Federal Reserve's proposal to ease capital requirements for lower-risk assets could free up billions of dollars for banks to invest in share repurchases, acquisitions, or loan growth. Despite these favorable conditions, Barnum acknowledged that sentiment can change rapidly. Ongoing risks such as inflation, the growing U.S. deficit, and geopolitical instability remain significant challenges. Remarkably, even banks that previously lagged behind are now showing signs of recovery. Wells Fargo CEO Charlie Scharf, relieved of federal restrictions on his bank's growth, celebrated this milestone by awarding employees a $2,000 bonus. He highlighted improved deposit flows, new account growth, and strong credit performance. Similarly, Citigroup's shares have risen nearly 30% this year as CEO Jane Fraser demonstrated the effectiveness of her turnaround strategy. Fraser introduced a new luxury credit card and plans to issue a Citi-branded stablecoin, showcasing the bank's innovative approach. She also praised the resilience of the U.S. economy, noting the adaptability of the private sector. In conclusion, while uncertainties persist, the current economic environment appears favorable for banks and consumers alike. This unexpected prosperity underscores the importance of adaptability and strategic decision-making in navigating complex economic landscapes.